But I think the rally in price is a combination of lower than expected supply and better than expected demand. But I want to be cautious about the demand numbers. Yeah, it's a little bit better. To give you an idea, we previously thought that May would be down 16 million barrels per day relative to pre-crisis. Now it looks to be down somewhere around 16. So about a million barrel per day improvement. But the one thing we need to be cautious about is that emerging out of lockdown, we got an immediate pop in the commuting demand, as you just referred to. The question is, what does the trajectory look like? It's not as fast as what China exhibited going back a couple of months ago, but it is much better. I think putting it all together, we now see demand down somewhere around 16 million barrels per day for the month of May, and supply down 12. That still leaves you a surplus of around 4 million barrels per day. But we saw yesterday in the DOE data, hey, it's turned the corner in the US. So some local markets are already in a deficit, but globally we're not. We do think the market globally will be in a deficit by early June.
You know, we're talking about higher prices, Jeff. It seems almost funny in a sad way because at $26.30 for WTI, I mean, that's a terrible number for many U.S. producers. I know you and your colleague on the equity side, Brian Singer, probably talk about this all the time. What does the world look like for producers at under $30 a barrel?
Well, the key is that prices need to stay at this level through third quarter. We need to rebalance this market. There's two things that need to happen. One, you need to draw the inventories that were built up over the last 2 months. And then two, you got to keep the production that's offline right now, keep it offline for another quarter or potentially even two to draw down those inventories. To give you some magnitude of this, we built almost 1.1 billion barrels of oil since the beginning of this crisis. You need to draw that down. Well, the way we think it'll happen, you stay in that $30 barrel range during third quarter, you draw 450 of it. Then in fourth quarter, the price can creep up to somewhere around 40, and you draw more of the less expensive to store, like on land storage. Yeah. We won't see normalized inventories till first quarter of 2021.
Have you been encouraged by the pace of production declines and the drop in new oil drilling rigs in the States?
I'm not going to use the word encouraged, but I would say that it did happen faster than what we expected. But let's also point out that the violence of the rebalancing process that occurred in April was far greater than what anybody thought was potentially possible. Yes, we all thought you could see negative prices like we had seen historically of minus 50 cents, minus $1 or something like that. But the magnitude of the decline, the viciousness of it, the inability to deliver oil really created an abrupt correction. In fact, when we look at this market today, we didn't think that we'd be turning the corner until the end of May, first part of June. And we're right now, almost the middle of May, and this market appears to have already turned the corner. We are in the inflection right now as we speak.
But the cure for lower prices is low prices. The cure for higher prices is high prices. You know what I mean by that, Jeff? It's like, everybody makes these extreme statements about production drops. Now we've got oil prices ticking up. They're not high by any means. We know that. But everybody's desperate for the dollar right now. Do you think OPEC and the G20 and everybody else is going to adhere to their agreements?
Yeah, and one of the key reasons why is when we look at the structure of the OPEC agreement, it was really initiated by the U.S. administration. In terms of, because we had Russia and Saudi Arabia in very different positions going into it. As a result, there's a larger entity that's policing these compliances than what we've seen historically. But also the fact that Saudi Arabia came out earlier this week, with core OPEC, cut an additional 1.2 million barrels per day, which will really do nothing to the price today, but will bring forward how fast you normalize those inventories. And as a result, when we think about the need to get this market normalized back up to, let's say, $45, $50 a barrel, it's in everybody's interest that's on the producer side. So I tend to think the compliance will be much better than what we had seen historically.
So what does that tell you about 2021? Listen, I know it's May, and we're already talking about next year, but that's how the equity markets function. The equity markets are based on what happens with the commodity markets that you follow. What are we looking at for next year, Jeff?
Well, actually, when you look at the relationship between the equities and the commodity, it started breaking down going back to 2017. So what it tells you is that these producers, when they have to bring on new supply in late 2021, we think you'll be back to 55 in June of next year. At that point in time, you're going to have to bring on new supply. Are they going to have access to the capital markets to go and do this drilling by issuing debt and other types of capital market instruments? The answer is probably no. Investors have had enough of this sector. They already had enough going into this, and if they hadn't had enough before, they're unlikely to be that interested this time around. What that tells you, when they need to grow production, they're going to have to grow it out of cash flow, which means you're going to need to see much higher prices. Our target for the second half of next year is $65 a barrel, with prices potentially even spiking up towards 70, as you need to get that cash flow up to get those rig counts up and begin to start to grow production again.